Real estate syndication. Invest in large properties with $10,000. What if I told you that you could own a piece of a $50 million apartment complex for just $10,000? No landlord responsibilities. No tenants calling you at midnight about broken plumbing. No property taxes on your personal dime. And you could do this from your couch while scrolling through your phone. This is real estate syndication. And it's quietly becoming the fastest way regular Americans are building serious wealth. I'm going to show you exactly how it works, why the wealthy have been doing this for decades, and how you can get started with less money than most people spend on a car payment. Let's go. Here's the simple version. A real estate syndication is when multiple investors pool their money together to buy one large property that none of them could buy alone. Think of it like a group investment where you're the silent partner. You put money in, the professionals run the show, and you collect checks every quarter. The sponsor, that's the experienced real estate team. They find the property, negotiate the deal, manage the renovations, handle tenant issues, and manage everything day to day. Your job? Write a check and wait for your returns. Let me give you a real example. A typical syndication might be a 200-unit apartment building in Austin, Texas or Nashville, Tennessee. The purchase price is $40 million. The sponsor needs $15 million from investors. They break it into $5,000 or $10,000 units. Suddenly, 3,000 regular people like you and me own pieces of this building without any of the headaches. You're not on any deed. You don't get calls about maintenance. You just get quarterly or annual distributions. That's profit sharing, based on how much you invested. Part 1. Why this beats traditional real estate. If you've ever considered buying rental property, you know the nightmare. You need 20% down. That's $80,000 on a $400,000 house. Then you're dealing with tenant problems, evictions, maintenance emergencies at 2 a.m., property management fees, and you're personally liable if someone gets hurt on your property. Syndications eliminate almost all of that. First, the barrier to entry is tiny. 10 grand instead of 80 grand. That money is deployed across a massive, professionally managed property. Second, you have zero operational responsibility. No tenants, no repairs, no insurance headaches. The professionals handle everything, and they get paid whether you make money or not. So they're highly incentivized to run things right. Third, you get diversification. Instead of all your real estate eggs in one house in your town, you own fractional pieces of multiple properties across different cities and markets. If the Phoenix market dips, you've also got Nashville and Atlanta working for you. Fourth, the returns are typically better than S&P 500 index funds over 5 to 10 years. We're talking 7% to 12% annual returns on average, plus appreciation. Compare that to the current dividend yield on the S&P 500 at around 2%, plus whatever stock price appreciation you get. Now I'm not saying ditch your Roth IRA or stop your 401k contributions. You should do both, but if you've maxed out those accounts, and remember, you can only put $7,000 per year into a Roth IRA, then syndications are a logical next move. Part 2. How the money actually works. Let's talk numbers because this is where it gets real. Say you invest $10,000 in a syndication that buys a 120-unit apartment complex. The sponsor projects a 5-year hold. They plan to renovate units, increase rents, improve operations, then sell for a profit. Your return typically comes from 2 places: annual distributions and a back-end profit when they sell. Let's say the sponsor projects 8% annual returns. That's $800 per year on your $10,000 investment. Not life-changing money, but it's passive income you didn't have before. More importantly, you're doing absolutely nothing for it. Then, when they sell 5 years later, hopefully the property has appreciated and operations have improved. You get your initial $10,000 back plus a chunk of the profits. A realistic scenario, you get your $10,000 returned plus $5,000 in appreciation and profit sharing. That's a 50% return over 5 years, or about 8.5% annualized. Meanwhile, you were living your life, working your job, not managing any tenants. Part 3. How to get started. Here's the honest part. Syndications aren't as liquid as your Fidelity brokerage account. You can't call up a broker and sell your position next week. These are typically 5-year minimum commitments. Your money is locked in. This is actually a feature, not a bug, because it forces you to think long-term and because lock-in periods help sponsors execute their business plans without investor panic. To get started, you need to find syndications. Platforms like Fundrise, Realty Mogul, and CrowdStreet let you browse opportunities with minimums starting at $5,000. Some require accredited investor status, meaning you make over $200,000 annually or have over $1 million in net worth. But many don't. Read the executive summary. Ask questions. Look at the sponsor's track record. Have they actually completed syndications before? Do they have real reviews? Start with smaller investments. Prove the concept with 10 or 20 grand before you go bigger. This isn't get rich quick. This is patient wealth building using other people's expertise and capital. You've got your emergency fund covered. Your Roth IRA is